was another wild day on Wall Street. Stocks surging with the major averages reclaiming most of their losses from Monday's market meltdown. The S&P and Nasdaq are now positive for the week. So if you got scared off earlier this week, is it the all clear? Is this the all clear to get back in? Pete, what do you say?
I don't know that it's the all clear because, quite frankly, I look at this as very much algorithmic moves to the upside, just like we're seeing to the downside. So I think that we are just in this market right now that's going to remain volatile. I know volatility came out of the market from 25 back into the 17s, but I don't see where we're not one tweet away from the volatility going right back to 24 or 5 and some of the concerns about the trade war or a Peter Navarro. The commentary from anybody involved with the White House right now could easily push this volatility higher fast.
So what does that mean? Stay on the sidelines?
So, well, I think you've got to be very selective is what it means for me. So, like, I've made a couple of ads over the last couple of days, but not nearly what I was making, weeks ago, for sure.
Listen, I think you want to keep an eye on the 10-year Treasury yield. I know that there was a lot of, noise about it trading 1.6, where it was 2%, just a week and a half, 2 weeks ago. But it's at 1.7, and now the equity market has obviously caught a bid here, and it feels a little bit better. And the other thing is the Dixie is stuck right here, too. So I think those two things, where they are probably more indicative of where equities go right now. And I just think that if there is another low in yields, I think equities are going to go back lower because I just don't think you're going to get that positive headline that you're hoping for. And it won't be substantive if it comes out. They're going to try to jawbone some stuff. So to me, your question is, what do you do? I think there were some good opportunities today. I know we're going to talk about, some things that reported. You had opportunities to get things that filled in earnings gaps over the last few weeks. They had good reports, and you want to get back into them. One of them was Disney. Another one was Google. I mean, there's names like that I think makes sense.
Well, if you think about where we were on Monday, and clearly, the sentiment on Monday was ridiculous. We had a special on CNBC. If you asked, there was universal bearishness. And if you look at the AAII bull bear readings, we're now at levels kind of mid to late December, both on bulls and in terms of where bears are positioned. So we've had a massive change in sentiment. That is very important for the market. If you look at what's performed since Monday and how it's performed, though, banks continue to be very much underperforming. Small caps, very much underperforming. Emerging markets, very much underperforming. There's no reason why those trends don't change. And what are people doing when they wake up in the morning? As Dan said, they're checking the 10-year, they're checking the yuan, they're probably checking oil. And those three things right now are going to continue to drive sentiment.
If you listen on these shows, because not only am I a participant in these shows, but I'm a viewer as well.
Like right now?
Well, now I'm speaking, so I'm a participant.
Okay.
But last night,
I'm trying to understand what you're saying.
Well, if you listen, I'll make my point. You keep interrupting.
Keep talking.
Last night, Pete said something that sort of stuck with me. He said you're going to see volatility of the volatility index. And it's very interesting, and he's right. You're going to see the VIX now go between probably 16 and 24 over the next month and a half. What we said last night was, you asked me, do you feel better about the market today? I said, yes. You had that flush. The market came back, set up today perfectly. Now, if you're looking for an exit point, just the opposite of what we saw the other day. You're looking for a huge move to the upside early, followed by a slow cratering, and that's going to probably be your top. And I think you're going to see that pattern for the foreseeable future.
All right. Well, if you think this rally is for real, our next guest has 3 ways you might want to play it. Let's go off the charts with Oppenheimer, head of technical analysis, Ari Wald. So, Ari, what are you looking at?
All right. Well, we've had a nice snapback today, but in general, when market volatility hits and thinking about buy lists and whatnot, our focus shifts to our highest conviction ideas. And that includes technology. I think the points about the tech sector, as much as it ranks high in our momentum work, you can't understate enough that no other sector has shown the type of broad-based participation across both capitalizations and industries. So let's chart 3 tech stocks from 3 different industries, all setting up tactically well in our work. First one, PayPal. Top-down tailwinds from a strong mobile payments industry. Check out the iPay ETF. And here's what you have to know about the chart. Right here, there's the 200-day moving average. Note that it's rising, indicative of an uptrend. Pull back into the 200-day. We define that as a near-term opportunity to buy long-term strength. No damage to the trend, how we see it. Next chart. Semiconductors, Texas Instrument. This Texas really integral to what was a 19-year breakout in the SOX index dating back to the year 2000. Now here's Texas on a 1-year chart, also getting through 1-year resistance. Breakout in the chart, often former resistance becomes support. I think it's checked back to that support level. I think building a base and set to start to turn higher. Texas, semi setting up well. And then finally, software. Now, SAP, bit of a deeper pullback here, but also into its rising 200-day. There's a gap in the chart there as well. And when we talk about themes, how we see it, no stronger theme in the market than software. Could probably rattle off 50 software charts that are going from the bottom left to the upper right. Thematically, you have broad-based strength in that industry, which is why we believe you can buy these pullbacks in a name like SAP.
You know what, Ari? Why don't you come on over?
Right.
Join us here on the desk. Jonah will bring the chair in.
It's interesting. You said that as if you were considering not inviting him over, but it's like, you know what? Why don't you come over?
You know, at every moment, there is a
There's a
decision to be
choice.
made. I could have
I love
easily
that.
not invited
I
Ari,
like
but
the fact that
I
it's-
have questions for Ari.
It's open, it's fluid.
We're talking about this market rally, S&P and Nasdaq now up for the week. So what do you make of this big turnaround? And does that indicate strength in the market, or how do you view this?
I see this volatility that we saw more recently and the volatility that we saw in May as well is really a shakeout. You know, kind of how we're framing it, we're at the tail end of a bear market rather than the start of one. If you look, for instance, at the MSCI All Country World Index, I think as a proxy for risk peaked back in January of 2018, bottomed in December of 2018. That was the bear market. You know, since the strength we've seen this year, this has reversed some downtrends. I think we're in the process of basing, but as we talk about these non-confirmations and small caps, transports, overseas equities, I think that's more backward looking. I see those indexes in a stronger position now than they were last year when they were breaking down from distributed tops. I think they're basing now, and you still have to see the confirmation. That's the all clear, but I think we're getting there.
Ari, to be bullish in software or tech, for example, or semiconductors, do you have to believe there's some U.S.-China deal on the horizon, or no?
I think that's probably more correlated to the semi trade. Semiconductors really been trading on-off in line and coinciding with the trade deal headlines. I think software really has been that all-weather leadership. You know, whether rates are going up or down, software in recent years has been able to withstand those oscillations.
Ari, I get you can draw those trend lines from the deck 24 lows through kind of the May lows to where we tested earlier in the week, and you're right, it's holding up across a number of different asset classes. But how about commodities, and how about the breakdown in resource names, but definitely oil, because these are charts that are breaking down, and they are leading indicators in some sense in terms of where the global economy is.
You're absolutely right. The equal-weighted commodity index falling below multi-year support. If you look back historically, right, you want to see that stabilize. That I do think we're at a point where commodities are in a longer-term range, much like how they traded in the 1950s and the 60s,
as they do,
and
actually.
90s.
Right.
And historically, that's been bullish for the market. You've seen some terrific bull markets coinciding with those commodity ranges. Good for the stock market, less so for stocks tied to those commodity prices. I think that's why you got to stay clear of energy.
So Ari, obviously the S&P 500 has been this outperformer on a relative basis to almost every other equity index in the world. What do you make of the fact you talked about that January 2018 high? Since then, the S&P 500 has made 3 new incremental highs. One last year in October, we had one earlier this year, and then we just had another one here in July. But they've been really slight. They've been by like 2% of the prior one. What does that tell you? Because to me, it tells me that the only time that it makes sense to buy stocks is when we get one of those pullbacks, but we're getting some pretty sharp pullbacks over the last 19 months. And is there enough to break it out? I just don't see what the catalyst is.
Right. Well, the strength in the S&P, it's really all a play on tech. U.S. over world, it's because S&P's got more tech. Big over small, it's because the S&P's got more tech. Growth over value, it's because growth's got more tech. So to really get the definitive breakout, you do need to see participation broaden. You need to see some of these other non-confirmations, small caps, banks, transports, get in the action. So we're not there yet. We're kind of stuck in this in between where we haven't gotten the confirmation yet, but I think we're setting up to do so. Like I said, I think these markets are basing, not breaking down.
Ari, thank you. Ari Wald of Oppenheimer. Pete, do you like any of Ari's picks?
Well, the one thing he didn't mention when we talk about all these different commodities is gold. And that's been on this absolutely unbelievable run to the upside, Mel, which tells me that people are still running for a little bit of cover. And that's why I think we're seeing gold and silver really moving to the upside. Once again, I'd say oil, it hit that 51 level and bounced right off it again. And it's happened multiple times now. So I can see that there's a little bit of, he almost is sort of saying, hey, look, there's a little bullishness, but there's still enough bearishness that it's not like he's fully committed to the fact that this market's ready to scream to the upside.